These folks are closing on Monday, I believe, next week. They're doing a straight 30-year fixed in the low fives, right? It's not a temporary rate buy down or anything along those lines.
Hello, everyone. Welcome to another Mortgage Minute. My name is Matt Thomas. I'm your host. I'm a local realtor, and I'm joined today by a phenomenal mortgage lender. His name is Brian Dewald. Brian and I are going to be discussing, as usual, several points of interest in the mortgage world. We're going to start out with this past week, which has been sort of historic. We actually saw our lowest rates in the past 3 years. We are going to debunk a couple of myths, and then we're going to go into a couple of success stories that I think you're going to enjoy hearing. So, Brian, let's first talk about this past week. It's been very eventful. We saw our lowest rates in the past 3 years. Last time they were this low, or at least the last time they'd hit that low, was when they were on their way up about 3 years ago. Tell us about that.
Yeah, so, we sort of preemptively thought about this and talked about it on our last episode here. And, what really was pushing rates to go as far as they were was all of this whacked out employment data, right? So, we did see that. We've kind of come, and a lot of times on the heels of a Fed meeting, we can get some pretty good news, which is exactly what we saw, right? Leading up to the Fed meeting, we had a bad jobs report. We were anticipating the Fed lowering their federal funds rate. We'll talk more about that momentarily. But yeah, it was a great week for mortgage rates. Some people were able to take advantage, and even got a few folks looking at refinancing their mortgage, which is great.
That leads me into our second point here, which is there's sort of this myth that when the Fed lowers their rate, mortgage rates tend to follow. But we actually saw a rate rebound last week after we hit those historic lows.
Right.
What do you think caused that rate rebound?
Yeah. So there's a few things. This is a great question, and it's a very, very common misconception. So I want to point out real quickly that the last four times the Fed cut rates, mortgage rates went up, right? So super common when that happens. The federal funds rate is the overnight rate at which banks lend each other money, right? Very, very, very short-term rates at which member banks lend each other money. There's not an immediate or direct impact on long-term rates like mortgages. So, in a nutshell, here's a really easy way to look at it. If I'm an investor and I wake up in the morning and I've got $100 to invest, I'm going to put my $100 into whatever's going to give me the most bang for the buck. Oftentimes when the Fed lowers rates, stocks shoot up a little bit, right? So I'm going to get a decent return on my $100 by the end of the day if I put it into stocks when they're rallying because the Fed lowered rates. The opposition to that is bonds, right? Bonds and stocks compete for investor dollars every day. So traditionally speaking, not all the time, but under normal circumstances, when stocks are going up, bonds are going down, and the bonds are what controls mortgage prices. So as the bonds start to go down, mortgage rates go up, and that's exactly what we saw last time when the Fed met.
Yeah, I really appreciate that explanation. That helps clarify things even in my mind. As long as we've been talking about this, that certainly is a good way of looking at things.
Yeah.
Brian, with all this talk about rates hitting their low in 3 years, people wonder, is this a trend that's going to continue? Are rates going to improve? And while, of course, nobody knows exactly, I did read some information from an expert that I think really has a good feel for what's going on in the market. And he specifically believes that rates are probably not ever going to get below about 5.75 or maybe 6 at their lowest without some pretty significant changes, maybe in the economy, maybe the labor market, those types of things. He specifically mentioned mortgage spreads. Can you tell us what mortgage spreads are and how you think that might be possibly keeping interest rates up a little bit?
Yeah, this is a great question and a great point. So the mortgage spread that's referred to is the relationship between a 30-year fixed rate mortgage and what's known as the 10-year treasury note or treasury bill. And in history, that spread has been roughly 1.5% to 2%. But ever since we've kind of come out of COVID and rates have gone up, that spread has increased to, anywhere from 2, at sometimes as high as 3%. It kind of averages around 2.5. So, the spread that we're referring to is the difference between the 10-year treasury note and what an actual 30-year fixed rate is. And as soon as that spread started to increase over the last 2 or 3 years, it's sort of kind of maintained there. There's been days where it's, been up and down a little bit, but, lenders, generally speaking, mortgage companies and big mortgage outfits have had so much more risk coming out of COVID, whether it's risk of refinancing and losing their tail on the back end of things, or, risk of people losing their houses, right? Some of those numbers are up a little bit. So a lot of those extra indicators are causing that spread to be at a little bit higher gap than we've seen historically. So, what he's basically alluding to is that that spread probably isn't going to change. We thought, and we've had our fingers crossed that would start to shrink by now. It certainly hasn't, and there's no real big news, it doesn't seem, on the horizon that's going to help, kind of lower that spread a little bit. So, the mortgage world, when it comes to rates being super low, loves bad news, right? COVID was instrumental for the mortgage world. Lots of things were bad news. And so, mortgage rates fell to lows there during that time. And there's nothing really on the horizon that we know of, hopefully, that we're going to see to do that. So no real huge indications that spread is going to shrink anytime soon.
Yeah, well, that's really helpful kind of definition of that, and that sheds some light. So what I think, I've been telling anybody who listens, we've sort of come through this summer of opportunity, and now I believe we're in a fall of opportunity. We still have a lot of really great opportunities, I believe, in the market. And not everyone is able to afford right now because prices have obviously been propped up so high. And we still have relatively high rates, although relative to, 3 or 4 years ago, not relative to the rest of history. But Brian, the whole point, as everyone knows by now, the reason that we do this Mortgage Minute, we take the time to, 1, inform you, and then 2, show you how to combat the challenges that we see in the market. So that leads us to some real success stories, in my opinion.
Yeah.
You had just mentioned that there was a client that you'd helped. They ended up with $38,000 in concessions plus a $10,000 price reduction for a total of $48,000 in concessions. That's really, that had to be a huge boon to their, to their opportunity and for them to be able to get into a house that they were looking for. Tell us about that.
Yeah, for sure, Matt. So there's, every time there's opportunities all the time, right? So my whole plan of attack and strategy for helping buyers right now is to really hone in on the affordability piece, right? Instead of watching the headlines and looking what, this online entity thinks the payment's going to be, right? When we get expert human touch in there to really analyze and help strategize some neat things to help, our folks buy houses, there's some really cool things out there that we're seeing. So, we look at this, a little bit came off the sales price, what helps for sure. But, when we get $38,000, even $10,000 in concessions to help buy the interest rate down, it makes a huge dent in what the payment's going to be. So when we look at the affordability piece, that's by far the strategy I hit hardest. We take a deep dive into looking at the numbers and the payments. By the way, when these folks are closing on Monday, I believe next week, they're doing a straight 30-year fixed in the low fives, right? It's not a temporary rate buy down or anything along those lines. So it's a really neat way to get buyers to check the affordability pieces. And it's just a huge home run for them. So I'm very excited.
Well, we've mentioned several success stories similar to this. To me, that seems like a real home run for sure. That's a lot of concessions. For me, it just seems like, every week we talk about, opportunities here and there. And if more people knew that instead of looking at the headlines, and thinking, well, there's a general statement out there, therefore it applies to me. If more people knew to contact us and it would take the time to reach out, we could probably show them where there truly are opportunities. And so again, that's sort of the goal of Mortgage Minute. I appreciate you sharing those things, Brian. To me, those are huge wins. And again, the reason that we do this in general. So, hey, thanks for your time, Brian. I appreciate it. We'll talk again shortly.
Sounds good. Thanks again.